A house in Austin, Texas that sold for $320,000 3 years ago is now listed at $685,000. A young couple wrote to me last week. They both work in tech. Combined income of $145,000 a year. Good jobs, stable. They wanted my advice on buying that house. I did the math for them. The monthly payment at current rates with taxes and insurance comes to about $5,200 a month. That's 43% of their gross income just for housing, before food, before saving, before anything else. I told them what I'm going to tell you. Don't do it. I've been watching something that deeply concerns me. Across America, in some of our most popular cities, home prices have climbed so far beyond what people actually earn that we're not talking about a housing market anymore. We're talking about speculation. We're talking about a bubble. And I've seen this movie before. Let me tell you what I'm seeing in these markets and why I believe many of these cities are headed for a correction that could devastate millions of families who are making what might be the biggest financial mistake of their lives. Now, before I explain my concerns, let me show you what the optimists are seeing, because there are good reasons people moved to these cities over the last few years. The bull case is actually pretty compelling if you don't look too closely at the numbers. Let's start with Miami and South Florida. I understand the appeal. No state income tax in Florida. Beautiful weather year-round. You wake up and there's sunshine. There are beaches. You can work remotely from a place that feels like vacation. During the pandemic, thousands of people from New York and California packed up and moved to Miami, Tampa, Orlando. The lifestyle story is powerful. Young professionals, retirees, businesses relocating their headquarters. The optimists will tell you Miami is becoming the next Manhattan, a true global city. They'll point to new construction everywhere, cranes on every block downtown, luxury condos, the Brickell neighborhood transformation. They'll tell you that as long as high-tax states keep driving people away, Florida will keep attracting them. And they're not completely wrong about any of this. The question is whether that justifies the prices. Then there's Austin, Texas. Now, Austin is interesting to me because it became the poster child for the new economy. No state income tax, just like Florida. But Austin had something else. It became a magnet for tech companies. Tesla moved its headquarters there. Oracle, tech workers flooded in. The city added hundreds of thousands of people in just a few years. The optimists call it the next Silicon Valley. They point to the educated workforce, the University of Texas pipeline, the live music scene, the quality of life. They'll tell you that as long as tech companies keep growing, Austin will keep growing. Young, educated people want to live there. Startups are launching there. The business environment is friendly. Real estate agents marketed it as the best investment opportunity in America. Buy now before it becomes the next San Francisco, they said. Phoenix, Arizona. Well, here's another sunshine story. Affordable compared to California, or at least it used to be. Good weather, retirement destination, golf courses everywhere. The optimists love Phoenix because it's in the path of the California exodus, people leaving Los Angeles and San Diego for lower taxes and cheaper housing. Phoenix was supposed to absorb all of that demand. Plus, it's a sprawling city with plenty of room to build. The construction industry boomed. Jobs grew. The population climbed. every real estate article from the last 3 years called Phoenix, one of the hottest markets in America. Las Vegas, Nevada, beyond the Strip, Las Vegas became another no income tax destination. People will tell you Vegas isn't just casinos anymore. It's families, it's tech, it's sports with the Raiders and now the NHL. The entertainment economy is diversifying. Housing was cheap compared to California. You could buy a nice house for half of what you'd pay in Los Angeles. Remote workers discovered they could live in Vegas and never pay state income tax. The optimists believed Vegas had finally escaped its boom-bust reputation and matured into a real city. Denver, Colorado. The lifestyle argument here is even stronger than the others. You've got mountains, outdoor recreation, skiing, hiking, craft beer culture, an educated workforce. Companies like Google and Amazon opened offices there. It's politically moderate compared to the coasts. The optimists called Denver the perfect combination of urban amenities and natural beauty. Young professionals moved there for quality of life. The job market looked strong. Housing seemed like a safe bet because who wouldn't want to live in Denver? Now let's talk about Los Angeles and Southern California. This is where the optimists really dig in. They'll tell you that Los Angeles has always been expensive. It's always been desirable. The weather's perfect. You've got beaches, mountains, entertainment, culture, diverse neighborhoods. Southern California isn't going anywhere. Even when people complain about taxes and crime and cost of living, they don't really leave. Or if they do, someone else takes their place. The optimists point to generational wealth in places like Newport Beach and Beverly Hills. They'll tell you that real estate in desirable parts of California has been a winning bet for 50 years. Why should that change now? San Francisco and the Bay Area. The optimists here make a different argument. They admit the city has problems. They know people left during the pandemic. They see the office vacancies, but they believe in the long term. They'll tell you that San Francisco is the innovation capital of the world. Every tech boom in history has centered there. Yes, remote work changed things. Yes, some companies left. But the core remains Stanford, Berkeley, the venture capital network, the concentration of talent. The optimists say you're not buying San Francisco real estate for the next 2 years. You're buying it for the next 20. It's a bet on technology and innovation. And that bet has paid off for decades. Seattle, Washington, here's another tech story. Amazon's headquarters, Microsoft nearby, Starbucks, Costco. Seattle built an economic engine that seemed unstoppable. The optimists love Seattle because it has both tech money and natural beauty, the mountains, the water, coffee culture, progressive values without California's dysfunction. Housing prices climbed for good reason, they say. High-paying jobs, educated workforce, limited geography that restricts supply. The same story as San Francisco, but with more rain and less chaos. And then there's New York City. The optimists here are almost religious in their conviction. New York is New York. It's the financial capital of the world. It's culture. It's Broadway. It's global. Yes, people left during the pandemic. Yes, crime went up. Yes, it's expensive. But New York always bounces back. It bounced back after 9/11. It bounced back after the financial crisis. It will bounce back now. The optimists tell you that Manhattan real estate has been one of the safest long-term investments in history. If you can afford it, you buy it. Someone will always want to live in New York. I could keep going. Nashville became the next it city for music and healthcare. Boise attracted remote workers who wanted small town life with big city incomes. Charlotte, Raleigh, Salt Lake City. Every market had its story. Every market had its optimists. Every market had real estate agents telling buyers to act fast before prices went even higher. Now, all of that sounds pretty good, doesn't it? These cities have real appeal, real job growth in many cases, real population increases, real lifestyle advantages. I'm not here to tell you these are bad places to live. Many of them are wonderful places to live. But here's what concerns me, and it's the same pattern I've seen before. Stop me if you've heard this one. In my 60 years of investing, I've watched markets get swept up in stories, compelling stories, stories that everyone believes, stories that sound so reasonable that questioning them makes you look foolish. I watched it with the Nifty 50 stocks in the 1,970 seconds. I watched it with dot-com companies in 1999. I watched it with housing in 2005, and I'm watching it now. The pattern is always the same. A good story becomes a great story. The great story becomes conventional wisdom. Conventional wisdom becomes unchallengeable. And by the time everyone believes the story, the price has already climbed so high that the story can't possibly justify it anymore. But let me ask you something. What happens when the story everyone believes stops being true? What happens when remote work ends and people have to go back to offices? What happens when tech companies stop hiring and start laying off? What happens when the exodus from California slows down or reverses? What happens when insurance companies pull out of Florida because climate risk is too high? What happens when property taxes in these cities double to pay for the infrastructure their rapid growth demanded? I watched this same optimism in Phoenix, Las Vegas, and Miami back in 2005 and 2006. The stories were just as good then, better actually. People told me those cities were growing, that real estate only goes up, that the fundamentals were sound. They called me old-fashioned for questioning it. Then 2008 happened. So let me walk you through exactly what I'm seeing in these markets today. And let me show you why the fundamentals tell a very different story than the headlines. Now, a house isn't like Bitcoin. I want to be clear about that. A house provides real value. It gives you shelter. You live in it. You raise your family in it. That's genuine utility. A house isn't some speculative asset that produces nothing. But here's my question. At what price does that shelter become financially destructive? I've always believed in simple tests. When I evaluate any investment, I look at fundamentals. What are you paying? What are you getting? Does the math work? Housing is no different. Here's my framework. I call it the Buffett housing test. First, the 3 times income rule. Historically, in a healthy housing market, homes should cost about 3 to 4 times the median household income. This ratio is held for decades because it reflects what people can actually afford. When you borrow 3 times your income, the monthly payments are manageable. You can save. You can handle unexpected expenses. You're not stretched to the breaking point. Second, the 28% rule. Your housing costs, and I mean your mortgage payment, plus property taxes, plus insurance, shouldn't exceed 28% of your gross income. Some people push it to 30%. But beyond that, you're over-leveraged. You're vulnerable to any economic shock. Third, the rent versus buy test. If buying a house costs you twice what renting costs, you're not paying for shelter anymore. You're paying for speculation. You're betting that prices will keep going up. That's fine if you know that's what you're doing, but most people don't. And fourth, the 20-year hold test. If you bought this house today and couldn't sell it for 20 years, would the monthly cost make sense for your life? Would you be comfortable with that payment, those taxes, that insurance for 2 decades? Because that's the true test of whether you're buying a home or gambling on price appreciation. Let me apply these tests to the cities I mentioned, and I'm going to give you real numbers. You can check these yourself. Miami. The median home price in Miami is now around $570,000 to $600,000, depending on which part of the metro area you're looking at. The median household income in Miami is about $55,000. Let me do the math for you. That's a price to income ratio of 10 to 11. Not 3 or 4, 10 to 11. Now let's look at the monthly payment. At a 7% interest rate, which is roughly where rates are sitting, your mortgage payment on a $570,000 house with 20% down is about $3,000 a month. But we're not done. Property taxes in Miami-Dade are running about $7,000 to $8,000 a year. That's another $600 to $700 a month. And here's where it gets really ugly. Homeowners insurance in South Florida has exploded. You're looking at $5,000 to $8,000 a year in many areas. Some people are paying $10,000 or more. Let's call it $6,500, which is about $540 a month. Added up, $3,000 for the mortgage, $650 for taxes, $540 for insurance. You're at $4,190 a month for a median priced house. Remember, median household income in Miami is $55,000. That's $4,583 a month gross. Your housing costs are consuming 91% of the median household's gross income. That's not home ownership. That's a financial trap. And here's what nobody's talking about. Insurance is now $500 to $800 a month just for homeowners insurance in South Florida. That's more than many people's car payments, more than their groceries. That's just insurance, because insurance companies are fleeing the state or raising premiums 50% to 100% at renewal. State Farm pulled out, farmers pulled out. The companies that remain are charging whatever they can get away with because the risk is real and someone has to pay for it. Want to rent instead? A comparable house in Miami rents for about $2,500 to $3,000 a month. So buying costs you $4,200 while renting costs you $2,700. You're paying 55% more every month to own. For what? The hope that prices keep climbing? That's speculation. Now let's look at Austin. Austin's median home price is around $520,000. The median household income is about $75,000. That's a price to income ratio of 7. Better than Miami, sure, but it's still nearly double the historical norm of 3 to 4. Monthly mortgage at 7% on $520,000 with 20% down comes to about $2,760. Property taxes in Austin are high. Texas has no income tax, but they make up for it in property taxes. you're looking at about $10,000 a year or $830 a month. Insurance is maybe $2,000 a year or $170 a month. Total monthly cost $3,760 on a median income of $75,000. That's $6,250 a month gross. Your housing costs are 60% of gross income. That violates every reasonable standard of affordability. And that's assuming you have 20% to put down, which is $104,000 in cash. How many households earning $75,000 have that kind of money saved? Austin's better than Miami because incomes are higher, but it's still stretched beyond reason. And here's what worries me about Austin specifically. The tech industry is slowing down. Layoffs are happening. Companies that were hiring aggressively are now cutting costs. If Austin's economy was diversified, that would be one thing. But Austin bet everything on tech. When tech sneezes, Austin gets pneumonia. Phoenix. Home prices in Phoenix have exploded. The median is now around $450,000 to $475,000. Median household income is about $65,000. That's a ratio of 7 to 7.3. Again, roughly double what's sustainable. The monthly payment at 7% with 20% down is about $2,490. Property taxes are around $4,500 a year or $375 a month. Insurance is maybe $1,500 a year or $125 a month. You're looking at $2,990 a month total. On an income of $65,000, that's $5,417 gross per month. Housing is 55% of income. Phoenix has a desert climate. Water's expensive. Air conditioning runs almost year-round. Your utility bills are going to be $250 to $400 a month. Now you're up to $3,300 to $3,400 a month all in. That's 61% to 65% of gross income. You cannot build wealth like that. You're treading water at best. And Phoenix, like Austin, is overbuilt. Drive around Phoenix and you'll see massive housing developments going up everywhere. The builders assumed demand would stay hot forever. It didn't. Inventory is rising. Days on market are climbing. The supply that flooded in to meet pandemic demand is now sitting there with fewer buyers. Las Vegas. Median price is around $430,000 to $450,000. Median income is about $63,000. Ratio of 6.8 to 7.1. Monthly costs run about $2,850 all in. That's 54% to 56% of gross income. Not quite as bad as Phoenix or Austin, but still unsustainable. And Las Vegas has a unique problem. The entire economy revolves around tourism and entertainment. When recessions hit, Vegas gets crushed. People stop taking vacations. They stop gambling. The jobs disappear fast. I watched it happen in 2008. Las Vegas was the epicenter of the housing crash. Prices fell 62% from peak to trough. Subdivisions were abandoned. People just walked away from their mortgages and left the keys on the counter. The city is showing the exact same warning signs now that it showed in 2006. Denver, here's a market that feels safer because the lifestyle is so strong. But the numbers tell a different story. Median price is around $570,000 to $590,000. Median income is about $85,000. That's a ratio of 6.7 to 6.9. Monthly costs with mortgage, taxes, and insurance run about $4,100. On an income of $85,000, that's $7,083 a month gross. You're spending 58% of gross income on housing. Denver's problem is that insurance costs are spiking. Not like Florida, but climbing fast. Hail damage, wildfires in nearby areas. Some properties are becoming difficult to insure. And like Austin and Seattle, Denver is heavily exposed to tech. If the tech economy weakens, Denver weakens. Now let's talk about Los Angeles. This is where the math gets truly absurd. The median home price in greater Los Angeles is around $900,000 to $950,000. The median household income is about $70,000. Let me repeat that. Home prices are $900,000. Incomes are $70,000. That's a price to income ratio of 12.8 to 13.5. The monthly payment at 7% with 20% down, which is $180,000 in cash, comes to about $4,970. Property taxes in California are complicated because of Prop 13, but new buyers pay current assessed value. You're looking at about $10,000 a year or $830 a month. Insurance might be $2,500 a year or $210 a month, $6,010 a month. Median gross income of $70,000 is $5,833 per month. Your housing costs exceed your entire gross income. This is mathematically impossible for the median household. Who's buying these houses? Either people with much higher incomes, which means the market is completely disconnected from local wages, or people stretching beyond any reasonable limit. Los Angeles has always been expensive. I understand that. But this isn't expensive. This is unsustainable. This is a market being held up by foreign buyers, wealthy investors, dual income professional couples, and people spending 50% to 70% of their income on housing with no margin for error. San Francisco, well, here's the extreme. The median home price in San Francisco proper is now over $1.2 million. Median household income is about $120,000, which is high because of tech salaries. But you're still looking at a price to income ratio of 10. Monthly mortgage at 7% with 20% down, that's $240,000 in cash, runs about $6,630. Property taxes are roughly $13,000 a year or $1,080 a month. Insurance maybe $2,000 a year or $170 a month. You're at $7,880 a month total. On a $120,000 income, that's $10,000 a month gross. You're spending 79% of your gross income on housing. Even with high-tech salaries, the math doesn't work. And what happens when tech slows down? What happens when remote work eliminates the need to pay San Francisco prices? The city is already bleeding population. Office vacancy rates are at record highs. Companies are leaving. The doom loop is in motion. Less tax revenue, more problems, higher taxes on remaining residents, more people leave. Seattle, median price around $800,000, median income around $100,000, ratio of 8, monthly costs about $5,400. That's 65% of gross income. Seattle is tied to Amazon, Microsoft, and tech. When tech booms, Seattle booms. When tech stalls, Seattle stalls. No diversification. All your eggs in one basket, New York City. The statistics here depend on which borough and which neighborhood. But let's talk about Manhattan condos, since that's where much of the speculation has been. A median Manhattan condo is running $1.1 million to $1.3 million. Monthly costs, including mortgage, taxes, HOA fees, and insurance, can easily hit $7,000 to $8,500 a month. Property taxes in New York are complex, but they're high. HOA fees in Manhattan buildings can run $1,500 to $2,500 a month by themselves. This is only affordable to high earners or people sitting on generational wealth. For everyone else, it's financially suffocating. Now, look, I'm going through these numbers because I want you to see the pattern. Every single one of these cities has housing costs that are double, triple, or in some cases 10 times what would be considered healthy. These aren't small deviations. These are fundamental disconnects between prices and incomes. The numbers don't lie. When housing in Miami costs 11 times income, that's not a market, that's a mania. When Los Angeles costs 13 times income, that's not appreciation. That's speculation. When Austin and Phoenix and Denver and Seattle all cost 7 to 8 times income all at the same time, that's not coincidence. That's a bubble. I keep hearing people say, but Warren, these cities are desirable. People want to live there. Yes, they are. Yes, people do. Desirability is real. But desirability doesn't suspend the laws of economics. At some price, desirability meets reality. At some price, people can't afford to buy. And when people can't afford to buy, demand falls. When demand falls, prices fall. This isn't investment anymore. This is speculation. You're not buying productive shelter at a reasonable cost. You're buying at peak prices and hoping someone will pay you even more later. That works until it doesn't. Now you might be thinking, but Warren, people said these cities were overpriced 5 years ago too, and prices kept going up. And you'd be right, they did keep going up. Bubbles can inflate longer than rational people expect, but bubbles always pop, always. And the longer they inflate, the harder they pop. Let me show you what happened last time. I remember 2005. I was sitting in my office in Omaha reading reports about housing markets in Phoenix, Las Vegas, Miami. Home prices were climbing 20%, 30%, even 40% a year in some neighborhoods. Everyone was excited. Everyone was buying. Real estate seminars were selling out. People were flipping houses. Contractors couldn't build fast enough. And I remember thinking, this doesn't make sense. While Phoenix home prices were up 60% in 3 years, Omaha was up maybe 8% to 10%. While Las Vegas was seeing bidding wars on every property, Omaha had homes sitting on the market for months. I could buy a nice house in Omaha for 3 or 4 times the median income, just like always. But in Phoenix, that ratio had climbed to 7 or 8. People would call me. They'd say, "Warren, you don't understand the new economy. These cities are different. They're retirement destinations. They have sunshine. They have growth. Everyone wants to live there. Real estate only goes up in desirable markets." I heard that phrase over and over. Real estate only goes up. Charlie Munger used to laugh about that. He'd say, these people have a 10-year memory. They don't remember what happened in the 1,970 seconds or the early 1,990 seconds. They think the last decade is permanent. The optimism in 2005 and 2006 was overwhelming. If you questioned it, you were dismissed as old-fashioned, out of touch, not understanding modern real estate dynamics. Banks were lending to anyone with a pulse. Adjustable rate mortgages with teaser rates, interest-only loans, stated income loans where you just wrote down whatever income you wanted. No verification. The whole system was built on the assumption that prices would keep rising forever. And for a while, they did. Phoenix peaked in mid-2006. The median home price hit about $260,000. That might not sound like much compared to today, but remember, median incomes were lower too. Adjusted for the local economy, Phoenix in 2006 was just as stretched as Phoenix is today, maybe more. Then the crash started. Slowly at first. Homes took longer to sell. Sellers started cutting prices. Then the cuts got bigger. Foreclosures started appearing. Then foreclosures accelerated. Banks started dumping properties. The whole thing spiraled. By 2011, Phoenix home prices had fallen to about $120,000, down 54% from the peak. More than half the value wiped out. An entire subdivision in North Phoenix I heard about went from 90% occupied to 30% occupied. People just walked away, left the keys, let the bank have it. What were they supposed to do? They owed $300,000 on a house worth $120,000. They had no equity, no way out. They were trapped. Las Vegas was even worse. The median price peaked around $310,000 in 2006. By 2012, it had fallen to about $118,000, down 62%, nearly 2/3 of the value gone. I knew someone who bought 3 investment properties in Las Vegas in 2005, paid about $800,000 total. By 2010, they were worth maybe $300,000. He lost $500,000, never recovered from it financially. The Las Vegas economy collapsed. The casinos were empty. Construction stopped. Tens of thousands of people lost their jobs. Unemployment hit 14%. The entire city was in crisis mode for years. Miami and South Florida, same story, different beach. Prices peaked in 2006 and 2007. Then they fell 50% or more from peak to trough. Condo buildings that were 100% sold in pre-construction ended up 70% vacant. Nobody moved in. Buyers walked away from their deposits. The buildings sat there empty with maybe 3 families on each floor. The condo market in Miami was destroyed for nearly a decade. I remember seeing photos of abandoned developments, half-built subdivisions with weeds growing through the concrete, signs advertising bank-owned, price-reduced every quarter mile. It was devastating for families who bought at the peak thinking they were making a smart investment. And California, now coastal California didn't crash as hard as the others. Beverly Hills and Santa Monica and Palo Alto fell maybe 20% to 25%. Painful, but survivable. But the Inland Empire, Riverside, San Bernardino, those areas fell 55% or more. Those were the California communities where working families could afford to buy. Those were the commuter cities, and they got destroyed. Here's what I learned from 2008. Location within a market matters. The most expensive neighborhoods with the wealthiest buyers held up better. But the middle-class suburbs that had surged the fastest fell the hardest. The speculative markets with the most investor activity crashed the worst. And here's the other pattern. Every market that crashed hard had the same 5 characteristics. Extreme overpricing relative to local incomes, heavy investor buying, rapid construction booms, speculation driving prices instead of fundamentals. And everyone's saying this time is different. Phoenix, Las Vegas, Miami, the California Inland Empire, they all had those 5 characteristics in 2006. They all crashed. Now, here's what worries me today. When I look at Austin, Phoenix, Las Vegas, Denver, Miami, and several others, I see the exact same patterns, the exact same speculation, the exact same affordability crisis, the exact same investor saturation, the exact same rapid construction, and I hear the exact same phrase, this time is different. It's never different. The details change, the story changes, but the fundamentals don't change. When prices climb far beyond what people can afford, when speculation replaces investment, when everyone believes prices will never fall, that's when you need to be most careful. So let me show you the current numbers, the specific data points that concern me about where we are right now. The national price-to-income ratio for housing hit 5.8 inches early 2023. That's the highest level since 2006. The normal healthy range is 3.5 to 4. We're 45% above the historical norm nationally. And in the cities I've been discussing, we're 70% to 200% above the norm. Recent market data shows Miami's price-to-income ratio at 11, Los Angeles at 13, Phoenix at 7.2, Austin at 7.1, Denver at 6.7, Seattle at 8. These aren't small bubbles. These are massive disconnects. Mortgage payments have more than doubled since 2020. The average monthly payment on a median-priced home is now about $2,850, compared to roughly $1,200 in 2020 when rates were at 3%. That's a 137% increase in monthly cost in just 3 years. Incomes have not doubled. Incomes have gone up maybe 15% to 20% in that same period. The gap is enormous. In the high-risk cities I'm discussing, the percentage of income required for housing has climbed to 40% to 70% of gross income. That's double or triple the healthy standard of 28%. People are stretched beyond any reasonable limit. One unexpected expense, one job loss, one economic shock, and millions of households are in immediate trouble. Adjustable rate mortgages have made a comeback. Recent lending data indicates that roughly 12% of new mortgages in risky markets are ARMs. That might not sound like much, but ARMs are a warning sign. They mean buyers can't afford the house at a fixed rate. They're gambling that rates will come down before their ARM resets. If rates don't come down, or if they reset higher, those homeowners are in trouble. Now let's talk about insurance. This is the crisis that's flying under the radar. In Florida, homeowners insurance premiums have increased roughly 400% since 2019. The average cost is now between $5,000 and $11,000 per year, depending on location and hurricane risk. That's not a typo. $5,000 to $11,000 just for insurance. Multiple major insurers have exited the Florida market entirely. State Farm, Farmers, and others pulled out. They looked at the hurricane risk, the litigation environment, the construction costs, and they said, no, thank you. The companies that remain are charging whatever they need to stay solvent. And even then, some are going bankrupt when major storms hit. In California, fire insurance is becoming unaffordable or unavailable in certain areas. Some mountain and foothill communities can't get coverage at any price. The state's FAIR plan, which is supposed to be insurance of last resort, is overwhelmed. When private insurance disappears, property values eventually follow. Here's the thing about insurance. When your insurance costs $8,000 a year, that's $667 a month. That's like having a second mortgage, just for insurance. How many families can afford that? And when insurance becomes that expensive, buyers disappear. When buyers disappear, prices fall. Investor saturation is another huge red flag. Recent real estate analytics show that during the 2021 to 2023 boom, investors bought roughly 31% of homes in Phoenix, 31% in Atlanta, 29% in Miami, 23% in Las Vegas. Nearly 1 in 3 sales in some of these markets went to investors, not families. That's a very dangerous situation. Investors are not emotionally attached to properties. They're running spreadsheets. When the math stops working, they sell fast. And when a third of the market is investors and they all start selling at the same time, supply explodes and prices collapse. And that's exactly what's starting to happen now. Industry reports indicate that investor buying has slowed dramatically. In some markets, investors have become net sellers. They're dumping properties. Not in a panic yet, but the trend has reversed. That's a leading indicator. The percentage of single-family homes now owned by investors in these markets is staggering. Phoenix is at 28%, Las Vegas at 23%, Atlanta at 26%. These aren't homes occupied by families. These are rental properties and investment vehicles. When investors control that much of a market, the market becomes fragile. Supply and demand dynamics are shifting fast. Months of inventory in Austin has climbed from 0.9 months in 2021 to 4.5 months now. That's a massive increase. Days on market in Denver went from 9 days in 2021 to an average of 47 days now. Homes are sitting, sellers are getting nervous. When property starts sitting on the market for months instead of days, that's a warning sign. It means demand is weakening. And when demand weakens, prices follow. Population and migration data shows another troubling trend. Census reports indicate California experienced net out-migration of about 343,000 people in a recent year. That's the population of a mid-sized city leaving in a single year. Some went to Texas, Arizona, Florida, but the exodus is slowing and in some cases reversing. Remote work which drove so much of the migration to these cheaper cities, is fading. Recent surveys show that about 60% of companies now require office attendance 3 or more days per week, up from about 30% 2 years ago. Full-time remote work is shrinking. Hybrid is the norm. That means people who move to Austin or Phoenix or Nashville for remote work might need to move back, or they might lose their jobs to someone willing to come into the office. When the reason people move to these cities disappears, what happens to demand? It dries up, and when demand dries up, prices fall. Make these numbers visceral. $5,000 for insurance in Miami is like having a second mortgage payment, just for insurance. 31% investor ownership in Phoenix means you don't have a housing market. You have a speculation market. Days on market going from 9 to 47 inches. Denver isn't a cool down. That's a freeze. When the market freezes, prices eventually crack. All of these data points are telling the same story. Affordability has collapsed. Demand is weakening. Supply is rising. Investors are selling. Insurance is exploding. Migration is slowing. And we're at the exact same point we were in 2006. The only question is how this unfolds and how fast. Let me show you what I think happens next. I don't make predictions about when. I can't tell you if this correction happens in 6 months or 2 years. Timing markets is impossible. But I can tell you how this most likely unfolds based on historical patterns and current conditions. Here's the most likely scenario for Florida, especially Miami, Tampa, and Orlando. The insurance-driven collapse. This is already in motion. Insurance costs are already pushing marginal buyers out of the market. Every time premiums go up another 30% or 40%, which is happening annually, another segment of buyers disappears. They simply cannot afford a $6,500 mortgage payment plus $8,000 in insurance. The math doesn't work. As buyers disappear, inventory rises. As inventory rises, sellers start cutting prices. As prices fall, homeowners lose equity. As they lose equity, some will walk away if they go underwater. Foreclosures will increase. More supply hits the market. Prices fall faster. This becomes a self-reinforcing cycle. And Florida is the most vulnerable because the insurance crisis there is worse than anywhere else. The second scenario is the tech layoff cascade. This affects Austin, Seattle, San Francisco, and parts of Denver. If we see another sustained round of tech layoffs, which is entirely possible as companies focus on profitability over growth, these cities will feel it immediately. Tech workers lose jobs. They sell their houses. But who's buying? The tech workers are the buyers. When they leave or lose income, demand collapses. Austin has no economic diversification. It went all in on tech. If tech stalls, Austin stalls. The city has massive oversupply of new construction that was built for tech workers who might not come anymore. You get a chain reaction. Job losses lead to selling pressure in an already oversupplied market. Investors panic because appreciation has stopped. Everyone heads for the exits at once. Prices drop sharply. The third scenario is the investor exodus. This hits Phoenix, Las Vegas, Nashville, and parts of Florida. When investors realize price appreciation has stopped, they don't stick around for 3% rental yields. That's not why they bought. They bought for appreciation. No appreciation means no reason to hold. So they sell Investors don't have emotional attachment. They don't care about the neighborhood or the schools or their memories. They're running a business. They'll drop prices 10% or 15% quickly to move properties. And when investors who control 25% to 30% of a market all start selling, the market crashes. Fast, because regular homeowners see prices falling and they panic too. Suddenly everyone's selling and nobody's buying. Las Vegas and Phoenix have been down this road before. In 2007 and 2008, they watched this exact scenario play out. Investor saturation led to investor panic. Prices fell 60% in both cities. The same setup exists today. Maybe this time prices only fall 30% or 40%. But that's still devastating for families who bought at the peak. The fourth scenario is the rate and recession double hit. If interest rates stay elevated, which seems likely, and a recession hits, which is always possible, the most over-leveraged cities will see the worst declines. High rates mean fewer qualified buyers. Recession means job losses. Job losses mean foreclosures. Foreclosures mean distressed inventory. Distressed inventory means price discovery. And price discovery means finding out what houses are really worth when the speculation ends. In this scenario, the cities with the highest price-to-income ratios fall the hardest. Miami, Los Angeles, San Francisco. The cities with the most construction and oversupply also fall hard. Austin, Phoenix, Denver. Combine high prices, oversupply, investor saturation, and a recession, you're looking at 30% to 50% declines in the most vulnerable markets. I'm not saying this definitely happens, but this is how housing busts unfold. This is the pattern. The trigger can be different. In 2008, it was subprime lending. This time, it might be insurance or tech layoffs or recession or all three. But the result is the same. Prices that climb far beyond fundamentals eventually return to fundamentals. The question is, how much pain is inflicted on the way down? So what should you do if you're thinking about buying in one of these cities? Let me give you my honest advice. Look, I understand the pressure to buy. You hear rates might not go down. You hear prices might keep climbing. You hear inventory is limited. You hear if you don't buy now, you'll miss out forever. All of that creates urgency. Fear of missing out is a powerful emotion. But let me ask you some questions. Answer them honestly. Can you afford this house if it loses 30% of its value? If the house you're buying for $600,000 drops to $420,000, will you be okay with that? Will you still make the payments? Will you be able to sleep at night? Can you afford the payment if your property taxes go up 40% over the next 5 years? Because in many of these cities, that's not speculation. That's what's happening. As property values rose, so did assessments. As cities strain under growth, they need revenue. They raise taxes. Can you afford it if insurance doubles again? In Florida, this is a real possibility. What feels manageable at $6,000 a year becomes crushing at $12,000. Can you handle that? Are you buying because you love the house and plan to stay for 15 or 20 years? Or are you buying because you're afraid prices will go higher and you want to get in? There's a big difference. If you're buying a home to live in for decades, you can ride out any temporary downturn. If you're buying for appreciation, you're speculating. Can you hold this property for 15 to 20 years if you need to? If prices fall and you go underwater, can you afford to just stay put and wait? Or will you be forced to sell at a loss? These aren't comfortable questions, but they're the right questions. Now let me tell you what I'm doing. I'm not buying real estate in these cities. I'm watching. I'm waiting. And that's coming from someone who has plenty of capital and can easily afford to buy if I wanted to. In Omaha, in the Midwest, in markets where prices never detach from incomes, housing still makes sense. You can buy a nice house for 3 or 4 times your income. Your payment is 25% of your income. You have margin for error. Those are investments. Those are homes. But Miami at 11 times income, Austin at 7 times, Los Angeles at 13 times, I'm not touching them. I don't care how beautiful they are. I don't care how desirable they are. The math doesn't work. My core principles haven't changed in 60 years. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. When I look at these markets, I see massive downside risk and limited upside. That violates my first rule. I'm not willing to risk a 40% loss for a potential 10% gain. That's not investing, that's gambling. Circle of competence is another principle I've always lived by. I understand productive assets. I understand businesses that produce earnings. I understand when the numbers make sense and when they don't. And right now, in these cities, the numbers don't make sense. Margin of safety is critical. When you buy an asset, you want a cushion. You want to buy it cheap enough that even if things go wrong, you're protected. There's no margin of safety when you're paying peak prices in a peak market. You're exposed completely. And price versus value, these are 2 different things. The price is what you pay, the value is what you get. In Miami, you're paying $600,000 for a house that produces shelter. But at what cost, when your monthly payment is $4,200 and rent is $2,700, you're paying $1,500 a month extra for the privilege of ownership and the hope of appreciation. That's not value, that's speculation. If you're determined to buy, let me give you some guidelines. Look at markets where prices are 4 to 5 times income, not 7, not 11, 4 to 5. Those markets still exist. They're not sexy. They're not on anyone's hot list. But that's exactly why they're safer. Look at cities with diverse economies, not cities that bet everything on one industry. Diversification protects you when that industry slows down. Look at markets where insurance is stable and affordable. If insurance costs are climbing 30% a year, that's a red flag. Look at places where investors aren't 30% of buyers, where families are buying homes to live in them, not to rent them out or flip them. Those are healthier markets. And if you can't find a market that meets these criteria in your price range, then rent, wait, save more money. There's no shame in renting. Renting is not throwing money away if buying would destroy your financial life. Renting gives you flexibility. It gives you time. It lets you wait for a better opportunity. Patience pays off. It always has. The people who bought at the peak in 2006 suffered for a decade. Many never recovered. The people who waited and bought in 2010 and 2011 did very well. Timing matters. Here's what I know after 60 years of watching markets. When housing prices climb this far above what people earn, when speculation replaces fundamentals, when everyone believes this time is different, it never ends well. Never. Miami, Austin, Phoenix, Las Vegas, Los Angeles, Denver, Seattle, San Francisco, New York. These cities might be wonderful places to live. I'm sure many of them are. Beautiful weather, good jobs in some cases, culture, lifestyle, all real. But wonderful places can still be terrible investments. And right now, buying a house in these markets isn't investing, it's speculating. You're betting that someone will pay you even more later, despite the fact that the fundamentals don't support current prices. You're betting that your income will grow fast enough to handle the burden. You're betting that insurance won't keep climbing. You're betting that rates will fall. You're betting that nothing goes wrong. That's a lot of bets. I've seen this movie before. I watched it in 2006. I watched it in Phoenix and Las Vegas and Miami. People told me I was wrong. They told me real estate always goes up. They told me these cities were different. And then 2008 happened. Millions of families lost their homes, lost their savings, lost their financial futures. Not because they were bad people, not because they were irresponsible, but because they believed the story everyone was telling them. They bought at the peak, and they suffered the consequences. I'm watching the same setup today, the same optimism, the same speculation, the same disconnection between prices and fundamentals, the same inevitable ending. Don't let fear of missing out destroy your financial future, because the biggest risk isn't missing the top. It's buying at the top and riding it all the way down. That's a mistake that can take decades to recover from, if you recover at all. Be patient, stay informed, protect your savings, and don't buy a house just because everyone else is. Buy it because the numbers make sense, because you can truly afford it, because it fits your life and your long-term plans. If that house exists in one of these overheated cities, fine. But if it doesn't, walk away. There will always be another house, another opportunity, another market. Your financial future is worth more than a bidding war in a bubble market.